for a few last-minute attendees to jump on. So sit tight and we'll begin shortly. All right. Well, with that, I think we'll go ahead and get started. So good afternoon and welcome to our live webinar, Small But Mighty, Annuitization Services for Sponsors and Advisors of Small DB Plans. On behalf of the entire team at Dietrich & Associates and United of Omaha, thank you for tuning in. My name is Krista Kotelis and I'll be the conference moderator this afternoon. If you have any technical difficulties with your webinar software today, please direct those issues to our tech manager, Lisa Straub, via the question area on your control panel. All questions related to the material presented today that are asked during the live session will be answered at the end of the presentation. They can also be sent via the question feature on your webinar control panel. And any questions that we aren't able to get to in the allotted time will be answered offline. Our panelists for today's session are Dan Smith and Carrie Roach with United of Omaha and Jeff Dietrich with Dietrich & Associates. Dan Smith is the National Sales Director for Group Income Annuity Sales at United of Omaha. Dan joined United of Omaha in 1982 and started working in the pension risk transfer market in 1985. Over the course of his career, Dan has been involved in approximately $1 billion annuity placements. Carrie is a Regional Sales Director for Group Annuity Sales at United of Omaha. Carrie joined United of Omaha in 1994 and headed up the East Coast Sales Office for 14 years. She then moved to oversee the West Coast operations. Carrie has specialized in the pension risk transfer marketplace for most of her career. And Jeff Dietrich has been helping plan sponsors manage pension obligations since 1999. An experienced consultant, underwriter, and transition manager, Jeff has served as a trusted advisor to Fortune 500 companies, municipalities, and the Pension Benefit Guaranty Corporation. Jeff works directly with plan sponsors, actuaries, pension attorneys, and the highest-rated life insurance companies to provide custom de-risking solutions. So with that, I'll go ahead and turn the presentation over to Jeff.
Thank you, Krista. And welcome, everyone, and thank you for joining us. Today will be the final session in our Ensuring Retirement Outcomes webinar series for 2016. Over the last 8 months, we have discussed the growing trend of pension de-risking, strategies for conducting pension risk transfers, various insurance products used to settle pension obligations, and most recently, adding retirement income products to defined contribution plans. I'd like to personally thank everyone who has participated and made this year's series a success. Replays of each session are available upon request. Today, with the help of a couple experts from United of Omaha, we are going to take a dive into the largest section of the pension risk transfer market, the small plan. We'll start by defining what a small plan is, how they are unique, and the annuity marketplace for them. Next, I will explain our experience and role in servicing the needs of small plan sponsors and their advisors. We'll then shift the presentation over to United of Omaha, the industry leader in the small plan annuitization space. United will share their insight and experience as an insurance provider to small plans, along with how their high-touch service model fits perfectly with the needs and objectives of today's sponsors and participants. We'll then round out the presentation with a discussion citing examples of how we have served the small plan market and address any questions you may have. Let's get started. What is a small plan? We define small pension plans in several ways. It's important to look at the plan in its current state and, more importantly, in its settlement state. In its current or ongoing state, a small plan typically has less than 500 participants and less than $50 million in liabilities, but it can approach 1,000 participants and liabilities up to $100 million in dollars. The plan itself is usually a legacy benefit plan covering multiple generations of employees and in a lot of cases, the plan is frozen to some degree. As you will see with this slide from the PBGC for 2014 single employer plans, shows the number of plans by participant count. Nearly 75% of PBGC covered single employer plans have less than 250 participants. Further, over 85% of the covered plans have less than 1,000 participants. This is the small plan market, and it's significant. Sponsors of small plans are usually highly paternalistic and hands-on. They maintain close relationships with their past and current employees and can wear many hats in their daily duties. In the settlement stage, which is when the plan is looking to annuitize liabilities, the actual annuitized liability is a fraction of the current or ongoing plan. The liability being settled is usually a mix of current and future pensioners, which we call retirees and deferred vesteds, and it is typically less than $20 million, and in most cases less than $10 million from a liability settlement standpoint. This is why it is important to look at a pension plan in its settlement state. Believe it or not, the small plan market is the traditional terminal funding market. It has been the prominent arena for annuitizing pension obligations over the last 35 plus years, and in some cases it predates ERISA. I would estimate that 80% of the plans being annuitized today are considered small market plans. But while more prominent, they don't have the size or name recognition of General Motors or Verizon, and don't receive the press that some of the large market plans do. The main catalyst of small plan annuitizations is a formal plan termination. Upon termination, plans are required to settle obligations by cashing out participants or preserving their benefits through a specialized group annuity contract. Alternatively, as more consulting is provided to small plans and sponsors become aware of the cost to maintain the plan versus the cost to settle the liability, partial liability settlements are becoming more prevalent. Specifically, annuitizing retiree liabilities and lump sum offerings for terminated vesteds. When conducting an annuitization, small plan sponsors are mostly concerned with service, the experience their participants will receive, the benefits being transitioned, being preserved as outlined by the plan, and the cost to settle. In most cases, small market plan sponsors have not annuitized benefits before and require the engagement of a specialist like Dietrich and Associates to guide them and their advisors through the process. At Dietrich, since 1980, we have specialized in providing fully integrated annuitization services. On average, we transition 60 pension plans per year from sponsor to qualified insurance companies, and 75% of those plans are in the small market. We are well staffed to process the volume of settlement activity in this market. Each plan sponsor receives an underwriter, which is their single point of contact throughout the entire process. Each underwriter is supported by an administrative team consisting of an actuary, compliance specialist, and record keeper. The process of annuitizing pension obligations is highly regulated, time-sensitive, and specialized. It starts with the engagement of one of our underwriters to meet with the plan sponsor and advisor to determine the plan's objectives, time requirements, and requisite plan information and data. Next comes the underwriting process, where we interpret the plan provisions and build a set of specifications that will be used to market and price the annuity, as well as to develop the insurance contract that will be the sponsor's proof of liability settlement. With small plans, the participants are very aware of their benefits and options. The underwriting process is critical in ensuring the preservation of them. Next, we solicit the market of qualified insurance companies to isolate those who will be able to take over the benefits. The market of carriers will be set based on the size, makeup, and provisions of the plan liability. Once the market is set, we perform a documented financial and administrative capabilities review of the carriers intended to meet the plan sponsor's fiduciary responsibility as outlined under ERISA and the Department of Labor's Interpretive Bulletin 95-1. Once the sponsor is comfortable with the market of carriers and ready to proceed, we then conduct a reverse auction process to generate final annuity pricing and assist the plan sponsor in the selection of a carrier and the acceptance of their offer. Once the carrier is selected, we begin the transition and notification process. This is the phase of the annuitization that will directly impact the participants. It is critical that the benefit transition is transparent and seamless to each participant. A successful transition is necessary to eliminate current and future administrative burden to the plan sponsor. This is especially important with small plans where the participants are very much in touch with the plan sponsor. If something goes wrong, the plan sponsor will surely hear about it. The process concludes with the issuance of a contract and individual certificates for each participant. Dietrich remains at the point throughout the entire process and beyond. We are completely integrated with the transition and the contract over its lifetime. And this is where our relationship with the insurance companies in this market is most beneficial. We are able to provide impactful advocacy on behalf of the sponsor and the plan participants. So today we're very pleased to be able to bring to you United of Omaha, the insurance industry leader in serving the small plan market. Like Dietrich, United prides themselves on a commitment to service, the participants they insure, and the group annuity market. We feel that their corporate culture and capabilities align very well with ours and the plans we serve. At this point, I'm going to turn the presentation over to Dan Smith to introduce you to United of Omaha and share his insights on the small plan market.
Great. Well, thank you so much, Jeff, and thank you everyone for calling in today to participate in this webinar. We're delighted at United of Omaha to have been invited to participate. What I thought I would do to start off is just explain who United of Omaha is and our relationship briefly to Mutual of Omaha. Mutual of Omaha is comprised of, the Mutual of Omaha companies rather, are comprised of a handful of affiliates, and United of Omaha is simply the life insurer affiliate of the Mutual of Omaha companies. It is by far the largest affiliate. United of Omaha probably constitutes 50% of the assets of the Mutual of Omaha companies, and a significant amount of the premium that is written inside the Mutual of Omaha companies comes from United of Omaha. At United of Omaha, we write primarily life insurance and then, of course, annuities, and that is where we're housed. Inside the retirement plan division, because we use a single premium group annuity to write all our defined benefit plan termination cases. Just to give you a little snapshot of what I'm going to cover today in the next 15 minutes or so is that I'm going to give you a brief thumbnail on the history of United of Omaha inside the defined benefit plan termination market, with particular interest, or I guess emphasis, on what we've done from 2011 to the present time. We're seeing a lot of growth in this market in the last few years, and I'd really like to drill down a little bit historically and just show you how this market is growing. We'll be talking, of course, about our own sales analytics in 2016, which have been great, and that reflects not only have we been good, but also the market's been good. So that's really a win-win for everyone. I will talk a little bit about what we would like to do in the future and the direction that we're heading. We'll also touch on some other annuity offerings that we have inside the retirement plans division. And then we'll conclude by talking about and really trying to drill down a little bit on our sweet spot here in the small market, and of course our commitment to service, which Jeff had touched on originally. I'm probably a pretty decent person to talk about the history of our defined benefit plan termination business, because basically when I started in retirement plans division is essentially when we started writing business in this space. We've been doing this since 1985, and when we started out, we basically, our business was in the micro market, and to define that would have been 100,000 to 5 million. I mean, 5 million back 15 years ago would have been a huge sale for us. Now today, we go from 100,000 to 20 million, but when we started out, we were basically a 100,000 to $5 million writer, and we stayed that way for a long time. It's only recently that we put a toe in the water and moved up to 10 million, and then just in the last year, we went to 20 million. But still to this day, the vast majority of our sales are in that 100,000 to $5 million range. So we're very conversant with those type of clients. We know how to handle them, and they're really our people, so to speak. So we have a lot of respect for the small plan market, and of course we're extremely active in that market. Just as far as a general analytic, we have $2.8 billion in pension risk transfer assets. We service approximately 75,000 annuitants, 56,000 of those are immediates, and we have a lot of cases. We have 1,650 cases. So if you kind of do the math back, and we've been around 30 years, I mean, that's over 50, it's over a case a week. I mean, that's been really the trajectory that we've been on since we started. The last few years have really been growth for us, and particularly for this market, for this small market. And I'd like to run down, just show you what our premiums look like and how they've grown. And then I'm also going to touch on something that's not on the slide, and that's case count, because I think that's also important as far as showing you how that market is growing and what the opportunities are for those of you who are intermediaries who work with Dietrich to participate in a market that's just getting frothier by the minute. I mean, there's just more and more activity. Let's just look at the premium here. I mean, so even back in 2011, 48 million, 94, 70, and then in 2014, we ramped up a bit, but more importantly, the market did as well. So we go from 151, last year we did 290 million, and this year, right now, we're at approximately 370 million. Okay, well, that's nice, and some of that is reflective of you know, we're writing slightly larger cases. So you might think, well, does that really demonstrate that the market is growing? I mean, it looks like United of Omaha is growing, but what evidence is there that the market itself is growing? And I think that lies with the following, and that is the amount of cases that we write, because we tend to be a bellwether for the market, are continuing to increase. Are we in a seminal position in that space, in that particularly that $100,000 to $10 million space? Absolutely. But are we demonstrably better than we've ever been? And I would say, as far as a closing ratio, I'm not really convinced of that. So again, kind of back to the win-win. I think we're growing, but if United of Omaha grows in the small case market, it's because the macro market around the small case market is growing as well. And I just want to throw some numbers at you. In 2011, we had 66 cases, 2012, 84, 2013, we had 53, but that was an anomaly. We ran into a very, very, very strong competitor that year who really kind of put the kibosh on us for about a quarter. 2014, back to 82. 2015, 133. This year, we're at 115. We did 18 in October. We're probably trending to do about 150 to 160 sales. Last December, we did 27. So if we can have that type of, finish to the year, we'll probably exceed the 150 number. Now, that just gives you an idea of the activity that's out in the market, because case count, to me, reflects velocity, and velocity reflects volume in this market. I mean, there's just a lot going on today. So I think to any of you who are intermediaries who work with Dietrich in this space, it's full speed ahead. I suppose for plan sponsors who may be on, I would say, well, you're not alone. I mean, if you're terminating your plan, there's a lot of action. And think about it. We're going to write maybe 150 to 160 cases. The vast majority of them say 10 million and under. And even if you want to gradiate it even more, go more granular, the vast majority will be 0 to or 100,000 to 5 million. And we certainly didn't have, I don't think, a 10-year treasury above 2% for most of the year. And I know today, the last I saw, it was like 182. I mean, and we look at that as a base rate, and then you go up from there. But still, I mean, interest rates are tremendously low. Just for comparison's sake, to really go back in time, when I started, I think the first deal I worked on, now again, I think we were looking more at 30-year back in the mid-'80s, and I think the rate was over 12%. So, of course, I kind of father time on that. But, I mean, that just gives you an idea of the activity. Interest rates don't seem to matter too much, as opposed to desire to get rid of the plan and asset levels. So I just, there's just a lot of action here. Since 2011, we've written 533 contracts, and actually 370 of those have been in the last 2 years, 10 months. Okay. Now, granted, we're doing a good job. I mean, we've really got ourselves in a good position there, but I think it as much reflects just the action in the market. And I think for any of you who want to participate in that small plan termination market, there's a lot of gold in those hills, that's for sure. As far as the future for us, best I know, I certainly feel that it's very bright, and I think that we'll continue to work in this space and really look to continue to ramp up on the volume side. At United of Omaha, our product is looked at as a very positive growth product, and our approach to this business is strategic. And what I mean by strategic is we're in it every day. We're out there looking for cases, underwriting cases, hopefully closing cases on a regular basis. We're not opportunistic that way. Oops, we're in the market. Oh, we're out of the market. We're in the market. We're out of the market. We don't do that. Number one, we need the volume. And because we're working in the small case market, I mean, we have to drive volume. There's no doubt about that. And also, there's so darn much volume anyway in the small case market that you can't really come in and out on an opportunistic basis, or at least we do not think so. So we're a carrier that will be very, very, very committed to this market over the long term. That's for sure. I would like to talk a little bit, just give you a little thumbnail on this, and then direct you toward to Jeff Dietrich or Dietrich and Associates at some other point if you're interested. And that's about some of our additional United of Omaha annuity product offerings. We have a couple different, what I'll call individual products that we offer inside the retirement plans division. We have, on the qualified side, we have an annuity for defined benefit for people retiring from defined benefit plans. We have an annuity for people retiring from defined contribution plan. And we also have non-qualified annuities. Now, these have to be corporate purchase. So they would cover things like SERPs, executive benefits, that type of thing. But again, those are kind of under that portfolio of individual products. So if you have interest in those type of products, please talk to Dietrich and Associates. They know a lot about our portfolio of those individual products, and they'd be glad to speak with you about that. Now let's talk a little bit about our small market sweet spot. Generally we've defined, for purposes of this conversation, the small plan market being from 100,000 to 20 million. And what that really means is that's what we're willing to underwrite to. Basically, we're willing to look at cases from 100,000 to 20 million. But let's drill down a little bit on those numbers. If I said earlier we've had 115 sales this year, well, probably at best, and this is by far the best year we've ever had as far as writing cases over 10 million, we've had, let's say, 15 million. And that's probably at the outside. I'm not positive on that number. But so we have probably done 100 cases that are 10 million and under. Okay? So let's now think of, well, from 5 million to 10 million. So what's left? There's 100 deals that we've done. How many between 5 million and 10 million? I don't know. Maybe no more than 15 in that space. Okay? So when you're really, really, really talking about the sweet spot at United of Omaha, or the sweetest spot, it's between 0 and 5 million. Well, some of that's just going to de facto be the case because that's where the most of the cases are in the small case market. Particularly after all the lump summing that's going on these days. I mean, a lot of cases that, maybe back in the day would have been 10 million, fall under the, into the 4 million. That's why there's a lot of activity in there. But the bottom line is I'd say that's our sweetest spot, 100,000 to 10 million, but particularly 5 million and under. Okay, so what kind of cases do we like? Well, we really like plain vanilla defined benefit plan termination deals that really match up with what most of the plans in this space have. That is where we have a mix of immediates and deferreds. There's not a lot of, or we hope there's not a lot of, underwriting that's outside of the norm too much, like lump sums at any time, that type of thing. I mean, we can work around that, but it's not something that we prefer. But we are day in, day out, plain vanilla, defined benefit plan termination writers. That's what we like. And that's why we like small plans, because most of them aren't doing lift outs, which if you've been, probably just talked to you about those before, but that's where they're just sawing off some liability on immediate only, or just immediates only, or they're doing buy-ins, buyouts. There's none of that really in the small case market, or at least not too much, and certainly none that we want to do, because we're just not competitive in that space. We're very competitive, plain vanilla, defined benefit, plan terminations. That's what we're looking for. When we gauge ourselves against our competition, when we look at our close ratio on cases between 100,000 and 10 million, I'm even willing to go up there, that have that mix of immediates and deferreds and is being terminated, we've been, I have here, one of my notes is 60%. I think now somewhere between 50 and 60. But that'll give you an idea of how dominant we are in that space and how committed we are to that space. Because you have to remember, like I said earlier, probably of that 60, to get to that kind of number, our close ratio on deals between 100,000 and 5 million, it might be 75%. If there's the mix, if we bid it, and there's that mix of immediates and deferreds, we have a lot of success there. And our overall, case size, I had said 2.9 million. We've had a couple larger cases that we've written lately, including one just the other day with Dietrich. So that might be pushing now a bit over 3 million, but that's kind of where we're at. I used to not even call it the small market. I mean, I'm more than happy to. I used to call it the micro market. And we love that space. We can handle the volume, because I'm gonna end by talking about service. But the bottom line for us is we can handle the volume, because we've always handled the volume. I mean, we started off as a high volume writer, and frankly, I don't see that changing. I don't think we're going to end up being a carrier that someday writes, $20-30 million cases, and that's all we're going to do. It's the opposite. I mean, we're set up. We have a great service team. We can handle 150, 160 cases a year or more, and we know what these small plans need. We are very good at high touch, because we have to be. I mean, we understand when we're talking to the people at the plan. Let's say we do a deal with Dietrich, and then we talk to, and let's say it's a $3-4 million case. We may be talking to, the HR person may be doing everything. There may be a treasurer there who's doing all this stuff. Everything around the plan term. So they need a lot of assistance from us and a lot of hand-holding. And not because they can't do their work, but we want to take as much off them as we can. And that's really one of our value propositions, is to provide tremendous service. There's another thing about our service that we feel very strongly about, and that is it's two-pronged. There's one prong, which is you got to take care of the plan sponsor. And, okay, we got to do we have to get the data from the plan sponsor, and we'll work with them on the contracts and the certificates, and, get all the information to people like Jeff so they can do their filings, that type of thing. But there's another part of this that I think we're very dedicated to, and that is taking care of the annuitant. When they get an intro letter from us, and this is at the annuitant level, and they get their certificate, they get their intro letter. We assign individuals to handle their case, so there will be a name and number on there. So we want that personalized service to flow to the annuitant as well. Okay, I mean that's a big part of what we're doing, and that stands us in good stead. And we really feel, as you can see on all the volume of cases that we write, that we have a really, really good feel for the small plan market, and that's always going to be a strong suit for us in that space. And before I sign off, I want to just talk a little bit about our relationship with Dietrich. I mean, it has been long. It's been going a long, long time. I don't have all the data in front of me, and maybe Jeff knows better, but I would just throw out, I wouldn't be surprised if we haven't done 200, 250 deals with them over the years. I've done that many transactions with them, and if that's the case, then you would think that probably in total premium over the years could be $500 million or so. It could be. I'm not sure. I wish I knew exactly. I don't. But let's put it this way. We've done a hell of a lot of deals with these guys, and we really, really value our relationship with Dietrich. They helped us in the market really when we were, getting started. Like helping us out, understand the business, and this goes way back. And they're just first-class organization. We love working with them, and I hope that all of you will too. So thank you for your time.
Thank you, Dan. I appreciate those kind words, and I think that the main reasons that the volume is there between our firms, one is that the volume is there in the market, and two, that we're both in those markets and serve those markets exceptional service. I can say that about you guys confidently, and in that vein, I'd like to introduce Carrie Roach, who is for the last, I don't know, Carrie, 20 plus years. I don't want to date us too much, but has been our personal representative with United of Omaha. She has overseen every transition that we've made over that time. She has been intimately involved in helping us with unique situations that we run across where we need a carrier that is flexible. A lot of the work that we do in the small plan space is kind of outside the traditional box. As Dan mentioned, you're not seeing a lot of the lift-outs, the settlements of just retiree liability in the small space. While we're seeing more of it, it's traditionally a termination, and terminations are very time-sensitive, very regulated, and complex from a standpoint of the liability that's being transferred. And you need a carrier that can handle that. And Carrie, as I mentioned, has been involved in every one of those. And what I'd like to do right now, before we get to questions, I know we're running up on time here, is get some of Carrie's insight into specifically some items that we see from time to time that are a little bit different and that really fit our companies and the value proposition. And the first is perfect for what we're talking about right now, fourth quarter activity. This marketplace has typically been a fourth quarter market. I would say that over half of the obligation being transferred happens within the last 3 months of the year. And Carrie, why, in your opinion, why is that? Why is the fourth quarter traditionally busy? And then, how do you define that, and how do you handle it, to Dan's point, with the volume?
Well, I think, thanks so much for having me on today. As Dan spoke to this growing trend, is that the important thing to remember here is that we've been always used to volume. Being a small case carrier, we've always written more cases than everybody else. And so, I think, I'll talk about the day-to-day. And so I think for my job in managing our quote activity, to how that translates to our transition teams, is that we have a lot of balls in the air. And particularly in the fourth quarter, it's my job to ensure that we don't drop any of those balls. So particularly, I think from the last few years of seeing this growth trend for us, we really looked at, are we staffed appropriately? Are we ready to handle the volumes that were coming our way? And I think, Jeff, you and I always talk about, particularly in fourth quarter, where cases, they're not simple anymore. And so as we become the plan, as we underwrite these plans and have to then be the plan for these participants who are going to elect their retirement options down the road, is how do we translate that? Are we able to price that effectively and make that a good choice for them? So ultimately, for the employer, year end, most plans are calendar year. They're looking to not have another year of all the hard costs that maintain these plans. TBGC premiums, the minute your calendar year clicks, you're paying that premium to maintain those plans, from actuarial investments, all of that. And so I think, as we say, despite the low interest rates, we're seeing the volumes of plans that have just pretty much said it's time for us to make that transition and focus on providing a benefit program that is for everyone in our company and not just for those who've had, a frozen benefit. I'd say one of the things that, we strive on for fourth quarter for us is that we're usually dealing with really tight timelines. We know what our transition timelines are for right now for a 1/1 transition. And, we really try to adjust and accommodate. We had 3 plans that pretty much didn't make our cutoff for a November 1st payment the last week and a half. And, we had teams working over the weekend, doing what they had to do to ensure that everyone's payment was there on the 1st of the month and that their check and their introductory letter was there on or before the 1st. And that happened on those 3 plans that went beyond our cutoff. So, we'll take tough situations and make them into good ones. So, and one thing I like to touch upon is that when other carriers are hitting capacity at this time of year, it's a real struggle for, I think, the consultants in being able to provide not only a well-priced product option, it's, do we have the product? Will we bid it? Will we not decline it? And then will we be competitive? And that's what I consistently hear is that, gosh, your number, given low interest rates, everyone's trying to cover shortfalls. We're trying to work with the consultant, with the client to make those numbers work, and ultimately, shorten the gap there to make and realize the transition for the plan.
Yeah, I think that's a good point, specifically with the growth in the market, the dynamics around transitioning liability, lots of participants, and doing it at a good cost. You can see at times in this market where competition is eliminated, and I can say that your pricing, regardless, is always consistent, and that supports your point of wanting to help the plan sponsor in doing this in the most cost-effective way. From a service standpoint, though, you mentioned tight turnarounds. This process has usually been something that can take a month or 2 or even more from a planning standpoint. And as we get into the fourth quarter, you see a lot of these groups that have to be done by year end. It's not uncommon to get a call on December 15th that the liability has to be transferred by the year end. So from that standpoint and understanding that, really this affects the participants. We don't want delays in payments. We don't want misunderstandings about what's happening. How is your model? How do you deal with that? Not necessarily the volume, but how do you have a positive participant experience in a time of transition that can be very quick?
Yeah, I think what you're kind of talking to is a little bit about touch points. And one of the concerns that I had when I first started in this industry and started to look at what plans were doing in transitioning their plan participants to become annuitants of ours. And when you have some of the smaller plans, I've known those that we couldn't get a hold of an employee, would go knock on their door and say, you've got to make your election here. We have owners that are very concerned about where their plan participants are going to go and how they're going to be taken care of. And one of the things I think probably why I've stayed with Mutual of Omaha, for 25 years now is that we have a little bit of that Midwestern, value proposition in that, you can have a plan participant as they transition to us who calls in with the most basic of questions of, switching my bank to we have participants who are coming up on retirement, have the option to make an early retirement option and can call in. Number one, they get a person when they call. They, are not thrown into a call queue. And so, I always think that that's a huge, huge point to make that we're taking on your plan participants for the rest of their lives. And so there's this transition time that we want to make it as seamless as possible for the employer to get everything over. And something as simple as keeping their withholding and their direct deposits the same. Well, we want it to be, not a life event for some of these people, because you've got 80-year-olds to people kind of wondering where their benefits going, to come, and they're 45. So that, that selected carrier is going to service them for the remainder of their life. And we want to ensure that, we're making it as seamless as possible for the employer, and, it's a welcomed change. And we tend to over-communicate and really help the employer to, let them know, who's going to be answering the call. I think back to one of my first pieces I wrote, which was a couple of union plans for the Boston Globe. And now, 25 years later, I still get phone calls from a couple of these guys, asking me about, their pension, and I hear about their grandkids and their life stories. And I think, Jeff, you were telling me the other day about, I think it's a CEO from Farmers Mutual who doesn't call you or me, but it's called our head underwriter, as he's been evaluating his early retirement decision, each year. And, he reaches our underwriter, he takes the time to speak with them, and that doesn't always happen every day in this world anymore. And so I think that's a huge point to say, as busy as we are, we take the time to do transition calls, we take the time to make sure that your concerns for a participant who has a quadro or varying family situations, that we'll take on that information. It becomes our information, and when that person calls in, we know exactly what happened or how to help them. And I think that really matters in what we do.
Jeff, in a nutshell, we have a really good underwriting area, and we have a really good benefit services group, and they're very committed to doing quality work.
Yeah, and I can attest to that. And the CEO story that you relayed. It is an annual thing, and it's not uncommon for me to get calls from presidents of companies that we've worked with, thanking us, not necessarily just for our service, but for how their participants have been handled through the transition and after, and sharing stories. So I think we're up against the window. I'm getting flashed here. I'm going to turn this back over to Krista to see if we have any questions, and go from there.
Great. Well, thanks, guys. That'll conclude the presentation portion of today's live session, like Jeff just mentioned. So we'll go ahead and open up that floor for question and answers. So go ahead, any questions that you may have to our panel. And just a reminder that you can send those questions via the question area on your webinar control panel, and I'll relay them. So I'll go ahead and start. So it looks like we've got one that came in earlier, and it says, we are considering de-risking our plan and maybe even terminating, but don't know if we can afford annuities. How do we know if we can afford annuities, I'm assuming, is a question.
I can start there. One of the things that we do the most around here is helping plan sponsors get to the point of termination or settling liabilities, and you don't really know if you can until you actually go out to market and see what the cost is. Most plans view their liability from an actuarial standpoint. Some of them are starting to view it from a accounting standpoint. Those are both different, and the termination standpoint is even more different because they're all based on different underlying assumptions. So really the best thing that you can do is to talk with us, figure out what it takes to go out to the market, get an idea of your liability. From there, you can understand the cost factors that will move that liability up and down, same way your plan does over the years. You can benchmark, you can monitor, and more importantly, you have the flexibility once you've gone through that process to affect a settlement at any point, because the legwork is in getting out to market and getting it set up. So I would recommend anybody that's considering it or even wants to know what their termination liability is to talk to one of your Dietrich representatives and get your liability out to market.
Great. All right, we got another one that came in. What are the timing requirements or constraints for annuitizing within a plan termination?
That kind of ties into what I said earlier. Within a plan termination itself, you're kind of at the mercy of the timing of the termination. There is a small window to distribute once you receive your favorable approvals from the PBGC and the IRS if you go about it. You really don't want to wait until that point, the point of distribution, to start the marketing of your group. As Gary mentioned and we talked about with the fourth quarter activity, we see a lot of that in the fourth quarter where we are approached with 2 weeks left to distribute. And while it can be done, it's really not the best way to go about things. So like I said earlier, the getting an understanding of what the requirements are and getting it out is the best thing that you can do. Timing-wise, I think you want to allow yourself 4 to 6 weeks for the process in a perfect world.
All right, we've got another question kind of in relation to those two. It says, I'm terminating my plan and considering offering a lump sum to my retirees. Will doing this affect the annuity purchase?
I'll take that one too. I don't know if United, if you guys have any, if you can talk about it from an insurance standpoint. What I can say is that we advise against offering retirees lump sums. It's kind of a second bite at the apple. More importantly, the savings that is generated by offering a lump sum to your deferred vested, your active population, isn't there with the retirees, especially in the current interest rate environment. I've seen cases where the annuity is actually cheaper than the cost of the lump sum because of how low those lump sum segment rates are right now. But mainly from, and maybe Dan or Carrie can comment on this, from a standpoint of the cost of the annuity, if you go out to your group and you offer lump sums to your retirees, those that do not take them, the insurance company is going to view them as the healthy ones, the ones that are going to live forever. And when they apply that mortality assumption to the liability, it's going to be greater than if you hadn't offered that. That's known as adverse selection, and you want to try to avoid that because, as I mentioned, it's not necessarily the cheaper option to begin with, and when you actually offer it, it makes the annuity even more expensive. Dan, Carrie, I don't know if you have any additional comment on that.
Oh, I have a brief comment, and that is we don't like it.
Okay.
Really, for the reasons that you said. I mean, yeah, you laid it out quite well. We don't like it.
Yeah.
All right. Well, we've got a few more
and
questions.
You'll pay for it. And you'll pay for it. Okay, how about that? We don't like it, and you'll pay for it.
Well said. All right. We've got a few more questions that came in. I know we're coming up on the 2 o'clock mark, and so I'll respect everybody's time. But let's knock out a few more before we close out today. Got one more. It says, I have a small plan termination where 3 participants have elected annuities. Is this something that can be annuitized?
Do they say what type of annuities they are? Are they immediates or deferred?
Does not specify. But you can relay on each situation, assuming there's both options.
Well, certainly we'd be looking for those 3 to add up to at least $100,000 in premium, and I would imagine if it was just the 3 deferreds, that we would want it to be up to maybe $250,000 in premium. Okay. The difference between underwriting deferreds and immediates is significant. I mean, if you have 3 immediate annuities, and I mean, we can bid 3 immediate annuities. We would hope that they're at least $100,000, and they probably will be, unless they're tiny benefits. But 3 kind of normal immediates, or that would be fine, probably at $100,000. I'm thinking, it's conceivable, like we have 2 immediates and 1 deferred. I still would think that the head underwriter, Brad Johnson, would probably want that to be, ideally he'd probably want it to be $250, because there's just a lot of extra work in looking at deferred. Not only is it harder to price, the certificate is more, I don't know, it's more complicated, and so is the contract. So it kind of depends on the situation, but again, we are committed to the micro market. There's no doubt about that. And we would take a look at it. I can't say de facto we would turn it down or bid it, but if it comes into Dietrich and they send it to us, I'm sure we would we'd take a look at it.
Yeah, that's where we go and twist Carrie's arm. I think you take this back to the retiree lump sum question too. By potentially stripping out your retiree liability of the plan, you are hurting your position for annuitizing if you are in that micro market. Like I said, there's not really any cost advantages of doing so. So by keeping that retiree group and then going through your lump sum process and adding on any default or elected deferred annuities, you've bettered your position for annuitizing that group.
Hey, Jeff, can I give you a real quick real-world example from this week of a case that we looked at? About a year ago, this guy had he had about 100. He had 100 immediates and a bunch of deferreds, but a lot of the deferreds, lumped out. And the advice that was given to him at the time was, because they're moving toward a plan term, and he knew he was moving toward a plan term, but he took the bait and decided to get rid of all the immediates, right? So he had 100 immediates that they bid, and they had 8 bidders. Uh-oh, now I've got 52 deferreds, and 5 people have retired since then. Guess how many people bid that case?
1.
2. 2. So he went from 8 to 2. And surprise, even the carrier that won the immediate, which 100 lives, it was a decent case, all of a sudden got amnesia that they said they'd bid the deferred. It's a funny thing, amnesia. So he was stuck with, and I'm telling you, I don't think, that's to your point. And that's a real world problem. If you're a small plan and you're going to terminate, then terminate.
All right, we had a good question in regards to interest rates. I feel like this one always comes up. I know we touched on it a little bit, but they always want to know, are we surprised that the plan termination market continues to increase activity in the face of recent and long-lasting low interest rates?
Who wants to deal with that one?
Yeah.
No, I'm not. This is Jeff. I've always made the case that interest rates are somewhat irrelevant in the grand scheme of things when you weigh all the factors. I think by the nature of the volume, it shows that. The volume is there because the education is there around the true risk of the liability and the cost to maintain it. And the options out there right now, we're in a low interest rate environment, obviously, but that is good from a debt capital standpoint. We have many clients that are creditworthy, that have gone out, raised capital, used it to fund their pension plan, budgeted, that debt, and have a clear picture of when they're going to be done, as opposed to the alternative of, well, let's wait for interest rates to rise and I'm going to continue to fund my plan and pay the PBGC. So, yeah, I think when you look at interest rates, you have to look at, what's involved with the plan and how you can use interest rates in your favor.
Kind of bouncing off that, Jeff, there's another question in regards to interest rates that came in, and I think this is a good one for Carrie and, United of Omaha as well, to carrier. And the question is, what is a general rule of thumb that the carriers use to determine how interest rate movements can affect price?
Well, it definitely is a factor. As I say, most plans will evaluate on an annualized basis, and up until now, that's kind of been in most people's minds the driving factor, because for the most part, their fees to administer the plan, what they were investing in. Those were just kind of the factors that they were looking at because interest rates have just been low for so long. I think that for us, we've had to, I know for us as a carrier, we've cut our margins. We've had to adjust, like most, to make the numbers work a little bit to stay competitive. So I think when you do go to the market, you're going to find that if you make that commitment to terminate, you'd be surprised that, the pricing is what it is. So I feel like everyone's kind of trying to accommodate the low interest rates, and we've had to make those adjustments where necessary.
All right, great.
Yeah,
well, I'm gonna.
No, go ahead.
No, just for time sensitivity, we're right at 2 o'clock, so I want to respect everyone's time here. Dan, unless you have something you want to add in last minute, I think.
No, that was great. It was wonderful. Thank you for having us.
Of course, and that's all the time we have for today. As a reminder, any questions that we did not get to will be addressed offline. And I want to go ahead and thank Dan, Carrie, and Jeff for a great panel. A recording of today's session will be sent to all attendees via follow-up email. And please keep an eye out for future webinar invitations. On behalf of the panelists and organizers, thanks for tuning in and have a great afternoon.
Thank you.
Thank you.